Good afternoon and welcome this afternoon to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Kevin Horner. Kevin's a 28 plus year veteran in the financial markets. He is there to help facilitate the conversation and helping to answer your questions. We're glad to have you here with us, whether you're in the recorded version or in the live version. Either way, be a part of that conversation. Comment or ask questions here in the chat if you're with us live. If you're in the recorded version, leave us a comment in the comment section, and we will get back to you as quick as we can. I appreciate all of the comments that we've been getting in those comments. That's great. So the market's doing some interesting things. I started this morning talking about what was going on with Walmart, and then I taught my trading futures webcast. And the market was kind of getting up and rolling, and rolling was, I think, kind of a question because it was up and down and moving around. And now here we are. It's kind of picking a little bit of a direction, but not really. We'll see what that looks like. But some individual stocks are, in fact, moving. And that is really the purpose of long option trading, for the most part, is to speculate on directional movement with individual stocks. And we talked about a few of those last week. We're going to talk a little bit more about some of those directional opportunities and ideas today. We'll talk about the factors involved in those long option directional trades as we get into this discussion. So I'm just going to say this at the very beginning before we even get into the housekeeping items. Trading long options is always a balancing act. There's not an absolute. There's never an absolute when you're trading options. It is always a balance between the impact of directional price movement, the length of time remaining in the option contract, the rate of time decay and the aggressiveness of time decay and the sensitivity of that time component as we get closer to expiration. And it is always a function also of supply and demand. So those are the forces at work: price, time, and volatility. How we balance those is how we hopefully, theoretically, successfully trade long options. And so let's jump in here really quickly as we get into this discussion. A couple quick housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only, not a recommendation for any particular security or strategy or individual symbol or anything else. We're going to use technical analysis and probability analysis both. None of those are guarantees about what's going to happen in the market. Schwab doesn't recommend the use of technical analysis, sole means of investment research. These are theoretical and don't guarantee anything. Also, we're going to be using the Thinkorswim desktop software platform. It is a great learning environment. It is not a guarantee of future success out there in the real world, and it does not do certain things that a live trading account will do, especially around the nature of where orders get filled. Also, remember, if you're going to trade options, remember that options trading carries a high level of risk. These are leveraged products. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option transaction. Past performance of any security strategy doesn't guarantee results or success. All right, so let's jump into the discussion here really quick. I'm going to pop over to the Thinkorswim desktop software platform, and we will take a look. By the way, you've got that chat out there in the conversation. Feel free to chat in and keep Kevin busy here. This is the one that I noticed right off the bat, and I'm going to come back to this really quickly, but I want to see what's going on with the market as a whole at the moment, because it's just been a couple of minutes since I've looked at this. I'm going to pop over here to our index grid and just see what's going on with the indexes. This is the S&P 500. We can see what's going on with the SPX. And it was up a little bit. It was down a little bit. It's now kind of sitting right in the middle. We've had these kind of two equilibrium candles, not a lot of directional movement. So not a lot of directional movement means that the whole market isn't moving. Doesn't mean that individual trades, individual instruments aren't moving within the context. Some of them have to be moving in order for us to get those highs and those lows in these candles. We've got to see some movement in that price as we get to that. Now, let's take a look at what's going on with the NASDAQ. Again, a little bit lower, gap down, a little bit of a rally today, but still kind of an equilibrium candle, kind of right at that level of support. And then the Russell 2000 kind of finding its way right in the middle if you will. We see a little bit of a gap. Well, maybe roughly an equal opening, and then it sold off just a little bit. Momentum kind of falling off just a little bit. So the market as a whole kind of staying relatively neutral today. It's a holiday shortened week. Number one, it's a holiday shortened week here in the US. Number two, it is a holiday shortened week for those countries. And not that that necessarily terribly influences the US options market, but it certainly does, I think, to a certain extent. Lunar New Year tending perhaps to have a little bit of a damper on overall volatility and overall market movement. So I want to pop over here to our VIX grid really quick, see what's going on with the VIX. And here's the volatility index. We can see that the VIX was up higher today, up to the 23 mark, up into that bottom of the 23 handle. Now bleeding off a little bit, kind of sitting right down here now at about 20, high 20 handle at the moment on the VIX. So a little bit of elevated volatility, probably reflecting the fact that it's a holiday shortened week, probably reflecting the fact that there's some geopolitical risk going on. We have a partial government shutdown going on. So there's a lot of things that are happening here that are keeping that volatility index elevated. So we have VIX down, but we have the market kind of neutral. And normally there's kind of that inverse relationship. Yeah, plus it's option to expiration week. It's third Friday of the month, so it is January, February, March. So not quarterly expiration, so it's not triple witching, but it is a monthly expiration cycle this week. So we don't have a lot of things other than those individual equities that are rolling off at this particular point in terms of those expirations. Now, that being said, you kind of see this level where the VIX has been reaching. This is kind of at that normalized high level, if you will. Go back to where these highs are. This 20 handle is about where VIX stays on the high end of its range, down in this 16, 17, 18 range, about where it stays on the low end. That doesn't necessarily benefit, since we're still in earnings season, doesn't necessarily benefit long options traders, right? An overall high VIX does not benefit us because a high VIX is met by selling, and that brings prices down. That works against us as the buyer of an option, as a long option trader. So pick our shots here from that standpoint, then from the perspective of looking for something that has lower implied volatility possibility. So a number of you are asking the question, can we go back and we look at that Dow trade from last week? And let's do that. I'm going to pop back over here to our chart. I'm going to go to our single grid view here, and the single grid view that I've got right now, I'm going to also open up on here. Let's put on here Dow DOW is the chart. And we were looking for that move to the upside. We're looking to see this kind of make that bull flag move, and it didn't. In fact, in the last 3 trading days, it's pulled back below this level. That was our price to take that trade off. And we were looking at setting that limit order and saying, look, that's where we're going to take this trade off if it goes to that measurement objective. Remember, I also said in looking at this trade that we had an earnings announcement in that last little run, which is why I attenuated that price target a little bit out to this level and used that diminished distance. We got about maybe, I don't know, what is that, 2/3 of the way? No, not even 2/3, maybe a third, I don't know, not half the way to that distance right there. And then it broke down below that support level. So going exactly in the opposite direction. And boy, can that happen? Yeah. But let's see what happened with this particular trade. So I'm going to go over here to the monitor tab. We're going to bring up our long options. Here's our Dow trade. Let's open that up. We bought it. 31 days to go until expiration. And so you're asking the question now, when is it time to close now? So here we have 31 days to go until expiration. This option contract, which we paid $4.15 for, has now lost $2.11. So roughly, well, no, it's not lost it's now currently trading at $2.11. So it's lost roughly $2, right? So it's lost about 50% of its premium. It's come back on us far enough that it really doesn't, maybe at this particular point, make sense to continue with 31 days to go until expiration. But let's see. So let's go to the option chain for this, for Dow, and let's take a look at this position that we have on here. So here we are, we're right at the money position. And that's actually, in fact, in this particular case, somewhat beneficial for us. You're saying, well, why is it beneficial for us that we're at the money strike and we're considering exiting this position? Because one of the things that we talked about, the reality of being a long option trader, is the idea of buying a little bit more time than we think we might need and buying a little bit more intrinsic value than we think we might need. And I think this is a good testament to that. Because we bought a little bit more time than some traders were thinking we might need to make that move. We still have some time value. Buying a little bit more intrinsic value, meaning we bought a little bit further in the money, means that we still have some value that we could sell back to somebody else and salvage at this point. We've got $1.02 of intrinsic. We've got $1.05 of extrinsic. Almost always our at the money strike. The stock's currently sitting at 31. We've got a 32.5, which is a little bit further away than our 30 strike. So our at the money strike is where we're sitting right now, basically. The at the money strike is almost always, if not always, almost always. I'm not going to say always, because in options, there's very rarely an always situation. We're sitting at a point where there's the most extrinsic value that we can get relative to intrinsic value at the money strike. It's the richest option when it comes to extrinsic value. The reason for that is this represents the coin flip. That 30 strike, or the at the money strike, represents basically the coin flip for market makers, because their risk is roughly equidistant directionally, right? Either up or down. Because remember, delta is a probability. Remember, options traders, option market makers generally aren't looking at directional trends, so they're kind of making these assessments based on order flow. The orders coming at them, they have to manage that risk. When the price of the stock is close to the current trading price of the current strike price, the risk is symmetrical and bidirectional. We as option traders might be looking at the chart and saying, hey, yeah, you know what, this is moving in a downside direction. So maybe we take this in a downside direction, or we were looking at that bullish trend and we were applying trend to the idea and maybe changing our kind of internal probabilities to match that. But the probabilities that we're seeing here on the chart, the probabilities that we're seeing in delta and in the option Greeks, are agnostic to trend direction, which simply means that this represents the greatest amount of risk for the market maker, which means that there's elevated implied volatility, which means that there's also elevated extrinsic value. So if we were to close this down, this is the point at which we may consider closing this down, because it's still got a lot of extrinsic value here. The longer we wait to close it down, the more we're losing inevitably to time decay. So let's go back to our option chain, and let's look at this in terms of our delta, theta, and vega components. Actually, I'm going to even look delta, gamma, theta, and vega, because gamma is now going to start to become a significant impact, because we're 31 days to go. We're now kind of inside that window where gamma begins to accelerate in its importance. So notice theta is only 2 cents. So that's the least important of our 4 option Greeks in this particular case. Directionally, we're still fairly sensitive to directional price movement. But remember that 63 cents cuts both ways. If the price of the stock goes down, we're also losing that amount, and that gamma is going to jam that delta down pretty quickly if this starts to go in a downward direction. So this is becoming a pretty sensitive position that we've got to do something with. It's not as sensitive from a time decay standpoint. We're still kind of out at 31 days to go until expiration. We're not down on the kind of really accelerated part of the curve. Vega here, remember, volatility sensitivity is higher the further out we are from expiration. So it's still fairly sensitive to implied volatility. So if implied volatility in this particular case were to rise, that benefits us. That's a good thing. But why would implied volatility rise in what was an uptrending stock? Well, implied volatility might rise or post the earnings announcement. If we were to turn IMP implied volatility on our chart and show that, we can kind of see where implied volatility is. It is relatively Okay, if we take out that big April spike, it's relatively high and starting to fall. So we don't want that working against us. So in answer to the question, is this potentially a time to close this trade down? Thinking about the fact that it's broken a level of support and it's got to come back up another 2 points in order for us to even just get above that, where we entered the trade, which was on that bounce and breakout, then yeah, I mean, directionally, we're fighting against this downside directional movement's fighting against what we want to have happen. We're at the point optimally where perhaps we could salvage a little bit of that time decay or a little bit of that time value, and we're not suffering from that time decay very much. And if implied volatility is going up, it's because the price of the stock is going down. So we're going to look at closing this trade down at this particular point. It just didn't do what we expected it to do. Is that okay? Yeah. Does that mean we made a bad trade? Absolutely heck not. Because you know what? Sometimes stocks move, and sometimes they don't move in the direction that we want them to. So you got to be willing to take that trade off and say, look, I'm willing to take a little bit of a loss here to get out of a position that could turn into a larger loss, and I could lose all $4 that I paid for this trade to begin with. So I'm going to go back over here to the monitor tab, and I'm going to say, all right, fine. The first thing I'm going to do is I'm going to come up here. I'm going to find that Dow trade, and I'm going to close down any working orders that I've got on that, and I'm just going to simply say cancel order. Boom, gone. That working order is now gone. Now I'm going to look at closing this trade down, and I'm going to try to work this a little bit. Currently sitting at 206 and a half. I'm going to create a closing order, and we're going to look and see if we can sell this for a little bit more than 201, which is the midpoint or the natural on this trade. I'm going to work this a little bit towards the mid 4, 5, 6, and very likely, because remember, this is paper money. So more often than not, it's going to fill at the mid, but I'm working it a little bit inside that bid ask at the 206 strike. I'm going to leave that as a day order. We're closing this down, confirm and send, and we're going to read through that order and say to close. I could do this with a stop, but a stop's not going to be as precise, and it's not going to guarantee where we're going to get filled. In fact, we could gap around it. We could have gotten kicked out on just intraday volatility, which is why typically some traders do not use stop orders on long options because of that intraday volatility. So I'm going to go ahead and I'm going to click on send. We're going to fire this order off, making sure that that's an order to close. And we're going to salvage what we can. We got it for 206. We got it right at the mid. Again, it's paper money. That's oftentimes what's going to happen. May not happen that way in your live trading account, but again, this is a fairly liquid stock, and it's making that kind of give us that opportunity to get in and get out. If it's not doing, here's the thing with a long option trade. If it's not doing what you expected it to do within the time frame that you expected it to do it, it doesn't really benefit you to hang on to it because of time decay, because of theta. It's the factor that then becomes the biggest consideration. Even if you have a high delta, theta is the inevitable. Delta is simply a function of price movement, and what if the price moves against you like this one did? So don't hang on to a trade necessarily just because it has a directional sensitivity that sounds good if the price of the stock does make a move, because the longer you wait, the harder it is to get off the bus, basically. Or the more expensive it is from that standpoint to get off the bus. All right, so there's that one. Let's take a look. We've got a couple of other trades here that we put on last week. That's our Dow trade. I think we had a couple of others. GE Verona. This is one I was looking at. Remember I said that we were going to look at managing this one? This is an example of a trade that's gone in our favor in this particular case. So this is the 670 long call, and the stock has gone up. And in fact, this has now become deep, deep in the money. Trade price, we paid $55.60 for it. It's now trading for almost $100 more than that. It's got 3 days to go until expiration. So I left this deeper into that coffin corner of expiration that I would have liked, perhaps, specifically as an example. And the reason I want to do this is this, because even, let's go to the trade tab, and I'll talk about that, Mega, so just a second here. So we're going to go to Dow. No, this is not Dow. This is, hang on, GE Vernova, GEV. GEV, boom. And long call, expecting the price of the stock to go up. It pulled back a little bit. Now it's gone back up again. 3 days to go until expiration. We want to look at potentially getting out of this trade. Probably should have gotten out of this trade earlier, but now here we are. So, whoops, I dropped my mouse off getting just all kinds of excited here. All right, so let's go to the let's go to the trade tab for our GEV trade really quick. And here it is right here. And we probably got to go. This is deeper in the money. We probably got to go. We got 50 strikes. Let's do 100 strikes and see if we can find it. Where is it? Where's our long call position? We got to go 120 strikes. This is way deep in the money. There it is. Way deep. This is really, so 670 strikes, stock's currently trading at 819. We had to go to 120 strikes to get to that option. So deep in the money. So let's look at the option Greeks. I've got gamma, delta, gamma, theta, vega. So the delta is 98 cents, which means that this is moving for all intents and purposes like the underlying stock, which is great. But, and you can see that this is bouncing between 98 and the dollar delta. It's not going to get higher than the delta of a dollar. So we're not going to get more directional efficiency out of this by waiting longer. Gamma, you notice here's the one benefit of the fact that we're way deep in the money here in this particular case. There's nothing else for this delta to do. So there's no gamma left. So we go to the at the money strike. If we scroll down this strike a little bit, we go to the at the money strike. And our gamma still in this particular case, even with 3 days to go, is only about a penny. It's not a big gamma, but as we get into the last couple of days, that gamma is going to increase significantly. You notice our theta at the money strike is pretty significant, $2.93 of any remaining extrinsic value. Vega is relatively insignificant, 30 cents. But we go deep in the money here, and everything else pretty much goes to a wash. No gamma sensitivity, no theta sensitivity, although it bounces back and forth. There is still some remaining extrinsic value here. And our Vega sensitivity is essentially nothing because it's not really an impact with 3 days to go until expiration. So we're just going to look at selling this. Now, what we could do with this is we could roll this from a deep in the money strike out to a more leverage strike and continue the party if our expectation was that the price of the stock was going to continue to move higher. And I think at this particular point, directionally, it kind of looks like it's bouncing up off of this support level here. So I'm going to keep the party going. Now, we could just close it down and start a new one. We're going to roll this. And remember, roll isn't anything magical. Roll is simply closing one down and selling and starting another one in one transaction. So we're going to roll this out a little bit in time. We're going to roll this up in terms of strike price, which means that we're going to roll down in terms of delta sensitivity. And then, Mega, I'll come back to your question as we get over here. So I'm going to go to the trade tab once again. And what we're going to do is we're going to create a rolling order here. So let's kind of look at where we might go. Expiration-wise, we might roll back out to this 31 days to go until expiration if our expectation is that the price of the stock is going to keep going. And our stock is currently trading at 821, so we're probably going to be pretty close up here in terms of some of these strikes. You notice that our delta goes down, our gamma sensitivity is still low because we're far out from time. Theta sensitivity now becomes a bigger issue because we're kind of right on the edge of that sensitivity. We're rolling back to a closer to the at the money strike, and Vega sensitivity becomes pretty significant. Let's look at our chart really quick. Vega is high and relatively stable, but could fall because we're post an earnings announcement. So that could work against us in this particular case, although overall, remember that volatility is still a little bit higher price-wise, kind of in the market as a whole. So I'm going to go back to that trade tab, and let's see if we can look at rolling. Stock's currently trading at 822. We're at the 670 strike. We could roll, let's say, for instance, to the 60 delta, which is the 800 strike. I kind of like that for nice, round, easy math. And we're going to pay 800. Okay, so we're going to pay 63.60 roughly for that. Okay. So that's going to be an option that is pretty sensitive to implied volatility, relatively sensitive to time, and pretty good sensitivity in terms of directional price movement. So what we would do then in this particular case is go to the monitor tab. We know it's the 800 strike that we're looking for in the 20 March expiration. So we're going to go to the monitor tab, and I'm going to take this trade and I'm going to right click, and I'm going to create, instead of a closing order, I'm going to create a rolling order. Now the Thinkorswim platform, when I create this rolling order, is going to keep it strike for strike. It's going to roll it out straight to the same strike, and it's going to roll it out to the next available expiration. So now we've got to do something manually here. I've got to manually adjust this to, because I'm selling the one that I'm currently long and I'm buying another one. And so I'm going to adjust the expiration. We're going to roll this out to the 20 March expiration. And I'm going to roll it out to the 800 strike, which is going to be cheaper. So we should be rolling this out for a credit. We're actually going to be booking some of that profit that we took in the trade and rolling this out for a credit. Basically, giving us that opportunity to book a little bit of that, what is now unrealized gain, is realized gain in this trade and keep the party going. So I'm going to do that. We're going to do that trade as a credit. I'm going to click on confirm and send. Now remember, rolling isn't a magic wand. It doesn't take away transaction costs. It doesn't take away liquidity issues or anything else. So your target that you're rolling to has to have liquidity, has to be trading. So you can't just magically wave the rolling magic wand, which it is not, and create a new position. You just have to think about this. So we're going to bring in a credit here to do this, this essentially roll. It's a diagonal roll, essentially. It's because we're rolling out in terms of time, we're rolling up in terms of strike price, and we're booking a little bit of profit in this trade. So now what I'm going to do, I'm going to put this back in our long options group. I'm going to make sure that this is the order that I want it to do, rolling from the one 3 days from now, the February option to the March option. And we're going to click on send, and we're going to fire that order off. And that roll happened. We got 92 bucks for it, which is cool. We rolled it for a credit. Now we are long this 20 March expiration at the 800 strike. Lower directional sensitivity, but more leverage because it cost us less. Same gamma, 0, because we're further out in time. Higher theta, because we're further out in time. There's more extrinsic value, but we're right on the edge of that curve, and we're closer to the at the money. Higher vega, because we're closer to the at the money and we're further out in time. So you got to pay attention to those relative sensitivities. Now, to answer Mega P14's question, why do these deltas over here on the put side have a minus sign in front of them? And that's just a reminder. So remember, what happens to puts when the price of the stock goes down? Put options get more expensive when the price of the stock goes down. Put options get less expensive when the price of the stock goes up. That minus sign is just there as a reminder of that inverse relationship because of the way that strike prices are displayed and the way that deltas are displayed. What that means is that if the price of the stock goes up, that 800 strike put option is going to lose 39 cents for every dollar that the price of the stock goes up. It also means that it's going to gain 39 cents if the price of the stock goes down. So that minus sign is just that reminder that that's the put side, that's an inverse relationship. It doesn't change probability or anything else. Probability approximation from delta is still the same. 39% probability of being in the money at expiration. On the call side, about a 61% probability of being, this is about a 31% probability. This is about a 61% probability. And you can see that those should be perfect. What's the word? There's a geometrical word for that. That should be perfectly, is it reflexive? That if this is 40, this is going to be 60. If this is 60, that's going to be 30, or 61, that's going to be 39. Is that reflexivity? I think it is, in terms of the mathematical or the geometrical term. Congruent, right? Okay, congruence. Okay, cool. I like that. So now that we've worked through a couple of those trades, The other one that I wanted to look at here, now that we've got that one in we never got into the Tesla trade, that never filled for us, so that working order is sitting there. Let's take the Disney trade. We never got into that one. The Campbell's Soup trade, we put on a couple of those Campbell's Soup trades. We put on the one that's long dated, and you kind of see the leverage difference here. Further out in time, we bought a slightly different strike. We bought a little bit deeper or a little bit further out of the money strike. We gained about 10 cents. The one that we bought a little bit lower strike that was in the money, had intrinsic value, a little bit higher probability, little bit greater leverage and directional sensitivity, has now made for us. So the one that was out of the money made 2.86%. The one that was slightly in the money, same move on the underlying stock, same time that we entered the trade, has made about 66% return, a better percentage return. So because of that directional price movement. So that's, a helpful gauge of buying in the money versus out of the money. Now, if the price of the stock makes a big move to the downside, better payout on that lower priced option, the one that is out of the money, the 30 strike. So bigger percentage return, but at the same time, lower probability of success. All right, I've got another bearish trade here that I wanted to look at, and that was this one here, which was it J&J? No, shoot. Now I don't remember which one it was that I was looking at. Was it this one? No, I looked at that this morning. Shoot. Was it MU? Hang on, I'll find it. Thank you. Yeah, it was a very hot trade. Let me look at this really quickly. Let me go back and see my recents and come back here. GV, DRI, Darden, DoorDash, Dash, Kroger, Coca-Cola, Altria, NDX, Micron. Maybe it was Dash. Let me take a look. I know it was one that was making a big move to the downside. Expedia. It might have been this one. Okay, because we were just post that earnings announcement. I think it might have been this one. I think it might have been Expedia breaking this level of support. And implied volatility was relatively high and falling. And so now it's a little bit lower, but as implied volatility continues, this is the conundrum of put options, right? Because we can buy low implied volatility and expect that implied volatility is going to go up. But we get into a situation like this post the earnings announcement when it's making a move on the earnings announcement, and that changes that implied volatility perspective. So you got to kind of take which factor you want to see influencing this trade, first of all. This is making a directional move. It's made that break below that support level, so we're going to look at trading this to the downside. So I'm going to look for a target down here, and I'm not necessarily going to be too worried about where that target might be. But if I were going to draw a line here, I'm probably going to draw a line along those support levels to maybe down here to this 160 mark, and looking for this to make that move down to 160, breaking below that support level. 50-period moving average starting to roll over here a little bit. On the earnings announcement, it broke lower. So let's go to the trade tab, and let's put together a potentially bearish trade here, a potentially bearish long option. So we're on Expedia. I want to pop open our today's option statistics and see where we are in our current implied volatility percentile. We're about the 43rd percentile. So we're not hugely high, nor are we necessarily very, very low. We're still lower than 50%. That implied volatility could rise, which would benefit us. It's coming off of the earnings announcement, so it's already been kind of crushed to the extent perhaps that it's going to be crushed. So looking for that potential downside movement here. So I'm going to go out in time. Now, here's the thing. We got to kind of put this into the time component. So we're past the earnings announcement, so we don't have that to pay attention to at the moment. So I'm just going to look for this and see how much time we might look at buying based on the width of the bid-ask spreads, because this is a pretty hefty stock, $200 stock. Used to be a lot more expensive. Still $200. Before the split, it was a lot more expensive. So we're to come here when it was Bookings Holdings and the other ones, I mean, then you had some, or when you had some higher prices in the stock. So what I'm going to do is I'm going to come out here. I'm going to look at this next monthly, the 17 April, 59 days to go until expiration, and I'm going to come to the at-the-money strike. I still have 120 strikes displayed, and I'm going to see how tight those are. And that's what 80 cents on a $200 stock. That's not bad for the market being moving at the at-the-money strike. That's not a bad split between the bid and the ask. But just for the sake of discussion, I'm going to check the nearest weekly and say, hey, where is that same $200 strike? And that width is about $3 wide in that one, because that one just got listed. And so I'm going to go out to the next one out, which is 121 days out to go until expiration, see if we've got an even narrower spread. And that spreads more than $1 wide. So that's kind of the winnowing process here for which of these expirations further out in time I'm going to choose. I'm going to choose the one that has the narrower bid-ask spread. So I'm going to go to the 17 April expiration, 59 days to go. Now, I could go to this one, but I want to give it a little bit more time. Remember, buying more time than we think we might need and buying a little bit more intrinsic value than we think we might need in order to give us something to deal with and to work with as we get closer to expiration. Now, as I look at this one, these are moving around a little bit. And if I go a little bit deeper in the money, these strikes are starting to get, those bid-ask spreads are starting to get a little bit wider here. That's 95 cents at the 210 strike. I'm okay with that probably. And again, I'm not looking for a specific percentage or anything else, but I like the 210 better than the 220 because it's a narrower bid-ask spread. I like the 210 better than the 230 because it's a narrower bid-ask spread. And that's about the narrowest that I'm seeing in this next little region here. So I'm going to go to that one. I'm going to go to the 210 strike. 54-cent delta, about a penny of gamma. We're far enough away that gamma is not really an issue. But it's got about 12 cents of theta, so I'm not working as hard. That theta is not working as hard against me as it will be as this gets closer to expiration. And it's got about a 32% or 32-cent vega, which means that if implied volatility goes up, that's going to work for me in this particular case. And if the price of the stock keeps going down, which is what I want directionally, that's going to be okay. So I'm going to look at buying this one, the 210 strike, and expecting that this is going to continue to move to the downside. So I'm going to do this first, and then we'll talk about a couple of other items of consideration as we wrap this part up. So I'm going to go to the 210 strike, and I'm going to look at buying this a little bit further out in time, because remember, I'm always going to be able to, I'm going to theoretically be able, unless there's some kind of a liquidity issue, be able to sell this back to somebody else at a later date, hopefully for more than I paid for it. That's the goal of trading, right? So I'm going to put this order in. We're going to click on confirm and send. I'm going to read through this order. Buy one, Expedia, 210 strike put for 2005, limit to open. I'm going to work that order a little bit. So I'm going to come back here and edit. So currently our natural is at 2005. So I'm going to work that in just a little bit. I'm going to see if we can get it for 20 or maybe even 1990. Now remember, this is paper money, so it's more likely to feel close to the mid price. Now, CB asked a question: did we consider how many open contracts? No, I was looking for narrow bid-ask spreads, which are generally going to be a reflection of demand and liquidity. 136 is about the same. About the same as 200 contracts open interest. When I'm trading one contract, 136 is contracts in open interest is about the same as 200 contracts of open interest. It's not that big a difference. Peach Bomb, can I do a sample vertical? No, because this is long options. We do have a couple of long verticals and short verticals webcasts that are great resources for that. But in this class, we're going to stick with just these directionals. Now, seriously ask the question, seriously, which sounds like nicely Johnson from Guys and Dolls. Nicely, thank you. How far does Vega look back? Well, Vega as a component is looking forward. In fact, remember Vega, which is the sensitivity of implied volatility, is a forward-looking instrument. Historical volatility looks back at what the stock has actually done. Vega is going to be reflective of what the options market thinks the stock is going to do. And so we're going to try to work this inside a little bit at the 1990 price level here. We're going to click on confirm and send, read through this order. We're going to put this in our long options group. We'll try to work that just a little bit. We'll see if we get filled. And we did at 19, because remember, paper money, we're going to get filled more often than not close to the bid ask. So Jim says, is theta high for that length of time to expiration? Let's take a look. It's a good question. So theta is what? 12 cents? Let's go out to a much longer dated option. Let's go out to the first leaps that's available here. Let's go out to the January 15, 2027 to that same strike, which is the 210 strike. And that theta is only 4 cents. So it's about a fourth of that. Okay. Let's go to the one that's 121 days to go until expiration and go to the 210 strike. Theta is 8 cents. It's starting to accelerate a little bit at that point, but not much. If we go down here, let's say to the one that is 24 days to go until expiration at the 210 strike, notice that Vega doubles basically, or that theta doubles basically. And as we get closer to expiration, because we're close to the at the money strike, Vega or theta sensitivity gets really high as we get close to expiration. So not terribly high, Jim. We're kind of on the back end of that flat range. So yeah, I mean, you got to put it into context. Seriously, where does the Vega data come from? That Vega number, that Vega sensitivity is a variable calculated from the Black-Scholes calculation based on implied volatility. Implied volatility is how the market expects the stock price to move. It's based on expectations, based on supply and demand for the option. When there's greater demand for the price of the stock to move up or down because of the earnings announcement or because there's more time, greater sensitivity to implied volatility. Less sensitivity when we get close to expiration, and that's going to be a function. That implied volatility is simply going to be a function of how options are priced. So, quick check on how we would manage this option contract. Let's come back to our monitor tab. Let's go to the trade that we put on, which was the Expedia trade right here. Let's open that up. We bought it for $19.35. It's already started to lose a little bit because directionally it started to come back up just a little bit. That can happen. So what we might do is we might say, hey, you know what? I'm going to put a stop on here, take this off at 50% of that theoretical maximum loss, or I might put an alert on there. But in terms of managing this, we want directionally this price of the underlying stock to go down. We want it to go down quickly, and we want it to go down a lot. Okay. If it doesn't do that, if it starts to go against us directionally, then I want to know about it. So I'm going to go back to the chart here. Where do I see the support level for Expedia? Probably some support at 175 and maybe all the way down here to 157. So what I'm going to do is I'm going to say, hey, you know what? If this starts going price-wise, starts to go against me, which it's already doing today, starting to go back up. If this starts to go back up against me, and let's say maybe it moves back up above that 50-period moving average, or in this case, the 200-period moving average, or even back up above this previous resistance, you know what I'm going to do is I'm going to set an alert right here. I'm going to right-click, and I'm going to create an alert, and I'm going to create an alert. Now, I can create that alert off of that study. I can do that simple moving average, and we can edit this. And we can say that study. So my study that I want to choose, edit that study, simple moving average. And we can make that our 50-period simple moving average. I can just simply, I don't want to go deep into this. I can just simply make it a price. So I can go marks at or above 218 right here. If that marks at or above 218, send me an alert and let me know that this is going against me. Then I can do something about the option trade. So that's how we might do that. Guys, time flies when we're doing this and when we're having fun with these trades. Let's come back over here really quickly. Remember, if you want to learn more about this, stops on options. We can put in here stops on options. and you can search for it here in the Trader Talks webcast page. Remember, when you do that, click on subscribe so that you can keep track of things. You can get alerts on when new content is dropped. Some great stuff there. You can always find us here in the Schwab Coaching. By the way, if you're going to be in San Diego, not this coming weekend, but the next weekend, Kevin's going to be there. I'm going to be there. We're going to be doing our Market Drive event, and you can join us right here. It is no cost to you if you're in that San Diego area. We're down on the waterfront. It's going to be phenomenal. We're going to feed you breakfast. We're going to feed you lunch. We're going to give you a great networking reception afterwards. Great day of content. Join us for that. And then we're going to be in Atlanta in a couple of weeks talking technical analysis and option strategies. And Rachel should be at that one too. So we will see you then. Guys, thanks for being with us today. My thanks to Kevin Horner for helping out. And we will see you guys again very soon. Take care, everybody. Bye-bye.